Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. Well, the markets are reacting. I don't know. Okay, I guess we have mixed markets. S&P. Like I see, Apple is even up today. So even in the Mag 7, we kind of have a combination of a few stocks going up and a few stocks going down. In general, the consensus is a little bit bearish, but for some reason, I guess the government shutdown isn't really feeling like it's going to take hold. In other words, that it's going to be short term as opposed to long term. Now, that has nothing to do with politics, nothing to do with anything. That's the way that I see the market reacting. The VIX is up, of course, but the VIX really didn't skyrocket. October 1st came, and as usual, actually last year on October 1st, we had a big move in the VIX index, and it almost instantly happened. So if I go and I look at the trades, I don't really want to get long anything. I don't know how you can go out and just buy stocks today or this week even until there's some resolution on what's going on. I mean, you can try to bottom fish if you want. There's nothing wrong with that. Try to catch falling knives. There's a few of them around that you can look at this as an opportunity if you would like. But I'm going to put together a VIX trade to go along with the VIX trade that we have on, right? We already went out and we bought, I think it was the 18 strike VIX with the October 22nd expiration. And that position isn't really doing much. The VIX, as far as the October 22nd futures contract is concerned, is still trading, it's north of 17, but right around 18. The position's down a dime or two. But by buying that position, you're looking for the black swan event. You're looking for a 3-4% down day in the index as opposed to just a 1%. So something over 2 or 3% to the downside that could drive the VIX above 20, 25. That's kind of the event that we're looking for if you're getting long the VIX with the October 22nd expiration. So last year, going into October, actually set up a VIX open wing butterfly. And so I thought I would do this again. The fact that the market didn't tank after the shutdown, the fact that the market's still kind of just hanging in there, I think this might be an opportunity on October 1st to go out and look at the October 22nd expiration and look at an open wing butterfly in the VIX. So let's do it. Let's go to the Tradier Pro software. And if you have any questions or comments, please do put them in the chat box. Happy to try to address them here on Options Guide TV. We want to make this a very interactive show. Share it with friends, family. It's free for everybody. Like to learn about options. Even if you have a general question about options, I'm happy to try to address it during the show. All right, so we have the VIX up, and the powers that be at Tradier, we do have a derived value, which is how I always calculate the VIX, right? In that if I'm looking at the October futures contract and I'm looking to see where the VIX is at, we always use the combo. Unfortunately, the Chicago Board Option Exchange doesn't publish the futures, so you have to have a futures account to be able to see the future prices of the VIX. They do have a delayed quote inside their website, but with that said, it's just quite simple. You go and you look and see, okay, where's the call on the ask, we'll say, is 149. You look over here on the ask, and it's 131 on the put. So the call is 149, the put's 131. Then you go to the 18 strike. All of a sudden, the put is more expensive than the call. The put is 167, and on the ask, the call is 135. So the future is between 1750 and 18. If you want to get granular, you just buy the most expensive one here on the 1750 and you look over here and you sell the put, because synthetically, and that's where the derived value comes from, synthetically, that's long the VIX. And that it is using the October options. But if you buy a call, it gives you a right to buy the stock at 1750, right? If you sell a put, that's an obligation to buy the stock at 1750. So if the market goes down, you get put the stock at 1750 in theory, right? That's the way the VIX you wouldn't get put because it's cash settled. But if the market went down, you'd be put the stock at 1750. And if the market went up, you would exercise and get long the stock at 1750. All right. So that means that the actual VIX is in October is, and I already did the math, it's 1764. That's where it's at, $17.64. We see the actual VIX index, not looking at the derived value, looking at the Yahoo Finance quote. And we see that at, my eyes aren't, I got to blow it up here a little bit. 1 second. 1632 right now. It's only up 1/3 of 1%. Like that's not even a normal day movement. So right now, yeah, 1633. It's up 5 cents on the day. I guess I guess there's just really not that big that just blows my mind a little bit. October 1st, and we have that news that hit before at midnight last night, and the VIX is just not moving. So let's do something that's neutral to bullish. So that's what our open wing butterfly is on the VIX, right? Not bullish on the market, because your counter, it's an inverse relationship with the market. The market goes up, the VIX goes down, the market goes down, the VIX goes up. That's usually the way it happens. I can't say 100%, but 99% of the time. All right. So we have the October 22nd expiration. I'm going to highlight that over here. On this side, we have the calls. On this side, we have the puts. It's a cash settled index, which makes trading, and if I can trade in cash settled indexes, I'd rather do that than trade in ETFs where you got to deal with the stock. So it makes it a very simple underlying to trade in. We're going to buy the 15 strike call. We're going to go up 4 points to the 19, and we're going to sell 2 of those. And then, so this is 4 points wide. Then we're going to stop short here on the 21 strike, and we're going to buy that. So for this to be a normal butterfly, not an open wing butterfly, you go 15, 19, and then 19 plus 4 would be 23. And that would be a normal butterfly in the VIX. Because we're stopping short and we're buying the 21, that's going to be a little bit more expensive. But we get the benefit that if it's above 21, the butterfly should trade for at least $2. Why? Because the long spread in the butterfly is 4 points. The short spread is 2 points. 4 minus 2, is $2, not $4, is $2. And right now we can get this done. It's looking at, let's call it 140 for $1.40. So that's what price we're at. So if it would trade for $2, we can still make 60 cents above 121, paying 140 total for this. So that also means that if the VIX finishes above 15 plus 140, that would be 1640. And the market's already there right now. Well, that's actually exactly where the market is at. That's interesting. 1639. I did not plan it that way, but that is where it's at. So the way that I look at this is you have to pay up. You have to pay juice to get the October 22nd, and you want to buy these option contracts. There's always a lot of juice in the VIX. So you pay $277 to get that type of movement, but we can reduce that cost and put it at 140, which really means right now we've basically taken the time premium out of the VIX, because the VIX is at the SPX, right, or the VIX right now is actually 1638. And that's right where our break even is at. If we went all the way to expiration and the market stayed right here, we'd be at break even. Now, realize that the futures contract is trading somewhere up here around 1750. We'll just call it 1750. We'll make it simple. It's a little bit over that, but it's right around that. So the marketplace right now has the VIX at that. If it goes up to 19 and closes there, well, this thing can trade for as much as $4. If it closes beyond 19, we can still be profitable. We just need this marketplace to finish above where it's at right now, which is 1630. It can't finish below that for us to not be profitable on this trade. So I'm going to show that in the what if calculator. So it's not a home run type trade, right? Like we were buying the 18 strike call. I think it was about, I'm going to say 10 days ago. And well, no, it wasn't 10 days, maybe 7 days ago. Maybe it was last Wednesday. And we're buying that 18, hoping for the black swan event, hoping that the VIX markets would go down 2, 3, 4% in a day, and you'd see the VIX spike to 20 or 25 before the October expiration, and then either sell a call and leg into a short or a long call spread, or just close it out, because we are just long an option contract. That is the goal of the 18 strike. And, so you ride it for about 15 days. When you get 10, 15 days away, you do something to that long call. Right now, I really expected the VIX to trade closer to 19 at this point in time. On the actual VIX, I'm befuddled by the fact that it's at 1633 right now. All right. But I like this as an alternative trade. I will put this trade on. It's not going to conflict with the 18 strike call that I am long, but it is an interesting alternative. And ideally, we would put this on Monday, but it doesn't really matter, because this big event didn't really do anything to the market. I mean, we have Google down a little bit. We have Microsoft down a little bit. We got the NASDAQ, Russell 2000. I mean, what are we here? 1 second. Let me see. We got the SPX down a tad. SPX right now is down 4 points. We have the Russell down, which we are short the Russell. We did a Russell is down. Russell is flat right now. Wow. And the NASDAQ is down 17 points. Like, we're basically flat on the market all the way across. All right, I like this trade. This is a very interesting advanced trade. But here, let's look at the profit and loss graph. This graph isn't going to be accurate, and it's a lot to do with the futures, right? But at expiration, this is the correct profit and loss graph, the hard lines. So the market is ideally right about here. This is where the futures is at. This is where the spot is at, right down here. We need the market to stay right about here, right about there. Anywhere above that, by that October expiration, we can be profitable on this trade. We're going to be more profitable if it goes out at 19, but if it continues on up, we can still make a decent amount relative to the risk. And the risk is going to be $1.40. The prices are what the prices are. So there's no messing with the option prices, right? The option prices are what is determining where the future is at. And yeah, this is a solid trade. It's a solid trade going into October. Unless I guess the only thing would be is if you think we're going to have a real strong October and the markets continue to set new highs, and then you see the VIX drift down towards 15. This is your low strike. If you're below 15, you lose the $140 on that trade. So what do you guys think? If you have any comments, please do let me know. Please do put them in the chat box. That will be the official paper trade for the day. And then I'm going to go back and look at the IWM trade that we have on. And in that IWM trade, we are going out to October 31st. So this is the Russell 2000 index. We bought the 245 and we sold the I think it was 235. Let me double check. And that trade is up a smidge right now. And gold just keeps setting new highs. And you know what other stock is up today? A little bit is UNH. Still like the UNH trade. I like where this is at. There's, some activity that's going on in UNH. It's up 159 or 0.5%. So that's a decent stock today. $1.77 at this point in time. I had the IWM up here. I think it's 1, 2. Let's hit this one. 411. No, was it 230 then? Somebody help me. Do we know it's 230? Yeah, there it is. So we put this on for like $4.50, and it's now trading for $5.21. So the market is down in the IWM since we put the trade on. The market was at about 243. It's now at 241. If you look at the chart in IWM, there's nothing too exciting. Like this is the target range. It hit the all-time high right up here. You see this area here and this area here, saying it bounced off of that. We're riding the 20-day moving average right alongside of it. If we break down, the next stopping point is the 50-day. The indexes do have a tendency to ride along the moving averages. I think the moving averages mean a little bit more in the indexes than they do in underlying stocks. And I do see this area. This is acting as a support area in the short term. Then we got the 50-day moving average down here. Very easily that we could see it, and that's why we targeted that range when we put on that long put spread. So I still like that trade. We're up about 75 cents on it, and we can look to continue to do that trade. Now, if we want to, as expiration gets nearer, we can close the 230. Let's go back to the trading page. Close the 230 as time withers away, and we can move it up. And by doing that, you capture the gain on the short option, and then you sell like a 235, and you don't get as much upside, but you do capture that gain, and you get to gain a little bit more on the 235 on the time decay. So that is a viable opportunity if we don't get to break down in IWM. And, it's going the right direction. It's in the world of chop. It didn't break out to a new high, so there's no reason to exit that trade. It's looking strong. All right. So I don't see any comments or questions. IWM, we're going to remain long. And the VIX trade, I still like that 18 strike call. I don't mind it. Surprised to see the market not react a little bit more harsh to the news, but I guess a lot of people don't think that it's going to last that long. That's the only explanation that we can have. And then going along with that, I do like the open wing butterfly in the VIX. That's an alternative. When you see news like this hit the market and the VIX not go anywhere, it's just, man, it's got some underlying strength to it. So with that said, that's it for this edition of Options Guide TV. And we'll see you this Friday for the next edition at 11 a.m. Eastern Time inside the Tradier Hub, hub.tradier.com. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.